This video will briefly explain how many of the private equity funds out there are providing access to pre-IPO companies across the country. But before I go into that, I'd like to show you a few things on the Before IPO website. At the top, you will see the current opportunities being offered, and further down, you will see some of the previous performers of companies that have already launched. For confirmation on the value that these pre-IPO deals have delivered, you have a running ticker with actual stock symbol that displays where they're currently trading at in the stock market right now. And if you place the mouse right over any of the previous performers, you will find the date of the company when it went public, along with where the company was priced out on the day of its launch. The obvious value in getting involved in the pre-IPOs is that you're taking down a position on billion-dollar private companies before they go public, in hopes that their valuation continues to increase now and throughout their IPO launch, and even beyond that. There is no doubt that the return on investment on many pre-IPOs have been really impressive, and this has caused many private equity funds to pop up everywhere around the country offering pre-IPO opportunities. And this brings us to, how does this all work? The way it works is private equity funds are put together to acquire shares directly from insiders. Insiders derived from early investors, friends and family, and employees of the company. Once the shares are secured in the fund, the investor is prepared to take down a position, and it's done by becoming a member of the fund. Once a company goes public, the shares are distributed to the investor's trading account. An example would be a TD Ameritrade, Robinhood, Fidelity. Once the investor receives their shares, they can continue to hold or sell their position. Let's use an example from beginning to end so that you can see how the pre-IPO access plays out. We will use in this example a $100,000 investment on a pre-IPO. Let's just call it ABC. ABC then goes public and the investment value goes to $230,000, giving a return of investment of $130,000. On that return of investment, the fund does what's called an 80-20 split, which is known as a profit-sharing model. The breakdown on the distribution for the 80-20 is done in the following way. On the $130,000 profit, of that $130,000, 80% would equate to $104,000. That goes to the investors, and $26,000 remains with the fund. Now, that distribution is provided in the form of shares only. Many of the private equity funds that provide you with this type of service is also providing you with a login, a portal, where you're able to view your current pre-IPO positions and any future pre-IPO positions that you would take down. Finally, the fund also allows investing with IRAs, Roth, SEP IRAs, rollovers, 401ks, pensions. Well, I hope this video was helpful. Please contact someone from our team to further discuss any questions you might have.